Every year, criminal organizations around the world generate an estimated $2 to $5 trillion in illegal proceeds from drug trafficking, corruption, fraud, and organized crime. That money presents a strange problem for the people who have it. A duffel bag full of cash can't buy a house. It can't be deposited without questions. It can't be invested, spent freely, or moved across borders without drawing serious attention. Before illegal money can actually be used, it has to be transformed, on paper, into money that looks legitimate. This transformation process is called money laundering, and understanding how it actually works reveals one of the more fascinating and consequential cat-and-mouse games in modern finance. The term itself comes from a colorful, though somewhat disputed, origin story, often traced back to organized crime figures in the early 20th century who allegedly used cash-only laundromats and similar businesses to blend illegal cash with legitimate revenue. Whether or not that specific origin is entirely accurate, the underlying concept has remained essentially the same for the past century, mixing illegal money with legitimate economic activity, until it becomes effectively indistinguishable from money that was earned legally. Money laundering experts and law enforcement agencies typically describe the process in three broad stages, though real-world laundering schemes can be far more layered and creative than this simplified model suggests. The first stage is called placement. This is the moment illegal cash first enters the formal financial system, and it's widely considered the most vulnerable and risky stage for criminals, because large, unexplained cash deposits are exactly the kind of activity banks are specifically trained and legally required to flag. Common placement methods historically have included breaking large sums into smaller amounts deposited across multiple accounts or institutions, a practice known as structuring, funneling cash through cash-intensive legitimate businesses like restaurants, car washes, or casinos, where it's difficult to distinguish legal revenue from illegal cash mixed in, or physically smuggling cash across international borders to jurisdictions with weaker financial oversight. The second stage is called layering, and it's often the most complex part of the entire process. Layering involves moving the money through a series of transactions specifically designed to obscure its original source, creating enough financial distance and complexity that tracing it back to its criminal origin becomes extremely difficult. This might involve moving money through multiple bank accounts across different countries, converting it between different currencies or asset types, routing it through shell companies, meaning businesses that exist primarily on paper with little or no genuine operations, or using complex investment structures specifically designed to be opaque. The underlying goal is always the same: create so many layers of transactions and paperwork that following the money back to its criminal source becomes practically, if not entirely, impossible. The third and final stage is called integration. This is when the now thoroughly obscured money is reintroduced into the legitimate economy, typically through investments that appear entirely normal on paper, such as real estate purchases, legitimate business investments, stocks, or luxury goods. At this point, the money looks, for all practical purposes, exactly like normal, legally earned wealth, complete with documentation that appears to explain its origin through legitimate business activity or investment returns. Real estate has historically been a particularly attractive vehicle for the later stages of money laundering in many countries, for several structural reasons. Property values can be somewhat subjective, purchases are often large enough to move significant sums at once, and in many jurisdictions, particularly at the time historical cases were investigated, ownership could be structured through shell companies or trusts that made it genuinely difficult to identify who actually controlled the underlying money. High-end real estate markets in major global cities, including London, New York, and various offshore financial centers, have faced significant scrutiny over the years specifically because of concerns about their historical use for this purpose. Shell companies deserve particular attention in this story, because they've played a recurring, central role in numerous major money laundering cases uncovered over the decades. A shell company is a business entity that exists legally, on paper, often with official registration documents, a corporate name, and sometimes even a nominal address, but with little or no actual operations, employees, or genuine business activity behind it. Shell companies can be used to receive and send payments, own property or assets, and create the appearance of legitimate business transactions, all while obscuring who actually controls the money or assets involved. Certain jurisdictions historically developed reputations as favorable environments for establishing these kinds of opaque corporate structures, due to a combination of favorable tax treatment, strong corporate privacy laws, and historically limited requirements to disclose true beneficial ownership. Some of the largest financial scandals of the past several decades have centered specifically around these mechanisms. The Panama Papers investigation, which became public in 2016 following a massive leak of internal documents from a Panamanian law firm, revealed the scale at which shell companies and offshore structures had been used globally by wealthy individuals, corporations, and, in some documented cases, criminal organizations and corrupt officials, to move and obscure enormous sums of money across international borders. A similar, related leak known as the Paradise Papers followed in 2017, further illustrating just how extensively these structures had been used worldwide. Financial institutions themselves have, at various points, faced serious legal consequences for insufficient anti-money laundering controls, whether through negligence or, in some documented cases, deliberate complicity. HSBC, for example, agreed to pay a settlement of nearly $2 billion in 2012, following a U.S. investigation that found the bank had allowed transactions linked to Mexican and Colombian drug cartels to move through its systems over an extended period, due to what investigators described as seriously inadequate anti-money laundering safeguards at the time. In response to decades of increasingly sophisticated laundering schemes, governments and international bodies have built an extensive, and continuously evolving, regulatory framework specifically designed to detect and prevent this activity. Banks and other financial institutions worldwide are now legally required to verify customer identities, a process known as Know Your Customer regulation, monitor for and report suspicious transaction patterns to government authorities, and maintain detailed records specifically designed to assist law enforcement investigations when needed. International bodies such as the Financial Action Task Force, established in 1989, work to coordinate anti-money laundering standards and policy across different countries, given that laundering schemes very often deliberately exploit gaps and inconsistencies between different national regulatory systems. Despite these substantial, ongoing efforts, money laundering remains an extremely difficult problem to fully solve, largely because it's fundamentally, at its core, a cat-and-mouse dynamic. As financial institutions and regulators develop increasingly sophisticated detection methods, those seeking to launder money continuously adapt their techniques in response, exploring new financial products, emerging technologies, and jurisdictions with comparatively weaker regulatory oversight. In recent years, cryptocurrency has introduced entirely new complexities into this ongoing dynamic, offering, in some cases, new methods for moving and obscuring funds, while simultaneously, somewhat counterintuitively, creating permanent, traceable public transaction records that have, in various documented cases, actually helped law enforcement investigators trace and ultimately unravel certain laundering schemes. Step back, and what emerges is a picture of an enormous, largely invisible financial shadow economy, existing quietly alongside the legitimate global financial system, transforming trillions of dollars in illegal proceeds every single year into what appears, on the surface, to be perfectly ordinary, legitimate wealth. It's a process built on the same fundamental principles as most large-scale deception: enough complexity, enough layers, and enough legitimate-looking paperwork, until the original, illegal source of the money becomes buried so deeply beneath legitimate-appearing transactions that separating the two becomes extraordinarily difficult, even for sophisticated investigators specifically trained, equipped, and dedicated to that exact task.